Welcome back to The Explainer. I'm so pumped you're here today because we're unpacking a really high-stakes case study in global manufacturing turnarounds. We're going to completely dissect Jerash Holdings' Q3 2026 financial report to figure out exactly how a modern supply chain company navigates a totally volatile market. If you're into corporate strategy and numbers that actually tell a compelling story, well, you're absolutely in the right place.
I mean, think about it. How does a global apparel maker bounce back from a nearly $700,000 loss to almost $2 million in pure profit in just a single year? That is a massive multi-million-dollar swing in what is a notoriously tough industry. Okay, let's dive right into this. Now, to solve this mystery, we're skipping the glossy press releases. We are going straight to the source material. What you're seeing here is the actual SEC Form 10-Q for Jerash Holdings, filed for the quarter ending December 31, 2025. By anchoring our analysis directly in this raw, unfiltered data, we get the unvarnished truth of their operations. No spin, just the facts. So here's our roadmap for today's explainer. We'll start with the business of Jerash, then look at the big turnaround, break down the balance sheet, check out the cash flow reality, and finally, explore their global tax advantage. Let's get right into it.
Starting with Part 1, the business of Jerash. At its absolute core, Jerash Holdings is officially a Delaware-based holding company, but their actual boots on the ground, the sewing machines, the factory floors, those are located in the Hashemite Kingdom of Jordan. They manufacture customized, ready-made sportswear and outerwear for massive, brand-name global retailers, so they aren't trying to be the next Gucci or anything. They're the reliable, invisible manufacturing backbone for the clothes literally hanging in your closet right now. It's this highly orchestrated logistical dance across continents. And their expanding footprint brilliantly illustrates their massive manufacturing scale. Since establishing Jerash Garments way back in 2000, their real growth engine has been aggressive expansion through strategic acquisitions. We're talking integrating the Paramount subsidiary in 2019 and then MK Garments in 2021. They've just systematically absorbed local capacity in Jordan so they can fulfill these immense global orders without missing a single beat.
All right, moving on to Section 2, the big turnaround.
It really all starts right at the top line. Check this out. $123.3 million in net revenue for the 9 months ended December 31, 2025. That's up significantly from $116.5 million the previous year. And look, you simply cannot orchestrate a financial turnaround without a massive engine of sales, right? Jerash clearly has the customer demand to keep their factory lines running at absolutely full speed.
Now, what's really interesting here is the stark contrast at the bottom line. Back in 2024, they were literally bleeding money, reporting a 9-month loss of nearly $696,000. Fast forward just one single year, and they posted a robust positive net income of almost $1.96 million. I mean, going from the red deep into the black in a margin-thin garment industry, that is a monumental achievement. So how exactly did they do it? Well, it wasn't just about selling a few more jackets, it was rigorous cost management. Their gross profit jumped from $17.08 million to $19.42 million. And since gross profit is just revenue minus direct cost of goods sold, this tells us their costs for raw materials, direct labor, and overhead, they're being managed incredibly effectively. They're making more products, sure, but they're also keeping a much larger slice of the pie for every single item they ship. Which brings us to Section 3, breaking down the balance sheet. Diving straight into the condensed consolidated balance sheet from their SEC filing. Notice the highlighted total assets line. Tying our narrative back to this raw data is absolutely crucial because it actually proves their recovery isn't just some clever accounting trick. It's backed by tens of millions of dollars in real, tangible assets.
To cut through the dense accounting jargon here, let's just look at their overall stability. Jerash holds $84.2 million in total assets against only $20.5 million in total liabilities. Subtracting those liabilities leaves a massive $63.6 million in total equity. For a capital-intensive manufacturing company, this incredibly strong ratio means they are deeply solvent. They're standing on a rock-solid foundation, ready to weather whatever economic storms come their way.
But what exactly makes up those assets? Well, out of their $56.7 million in short-term current assets, a massive $26 million is locked up in physical inventory. Another $11.4 million is in liquid cash, and $7.8 million is in accounts receivable, which is just money customers owe them. And honestly, this structure is highly typical for a global manufacturer. A huge portion of their wealth just has to be tied up in fabric, finished jackets, and the working capital needed to constantly feed a massive global supply chain.
Okay, let's pivot to Section 4, the cash flow reality. Anchoring back to the statements of cash flows, pay really close attention to the operating activities here. The net cash provided by operations is actually in parentheses, which in accounting speak means it's a negative number. So let's unpack exactly why that is. The crucial takeaway here is that despite celebrating a really strong net income of almost $2 million, their day-to-day operations temporarily burned through $3.49 million in cash. Why? Well, it's just the reality of manufacturing. They experienced a $4.75 million change in accounts receivable, meaning they shipped out tons of product, but they are still waiting for those big retail brands to actually pay up. Simultaneously, they navigated a $1.67 million adjustment in inventory. So it's a really vital business lesson. You can be highly profitable on paper, but still temporarily burn cash as you build up inventory and wait for those checks to clear.
Finally, Section 5, a global tax advantage.
Let's look at their Jordanian tax concessions, because this builds an incredible competitive moat. By operating out of designated development zones in Jordan, Jerash is subject to a remarkably low corporate tax rate of just 10%, plus a minimal 1% social contribution. And it gets even better. They enjoy a 16% sales tax exemption on local purchases. Guys, this is not a loophole. It is a deliberate, legally sound strategy that gives them a distinct advantage over manufacturers in higher tax regions. They simply get to keep more of every single dollar they make.
Pulling all these threads together, the big picture really becomes crystal clear. Strategic geography combined with brilliant tax efficiency directly pads the bottom line. It's not just about sewing garments quickly, right? It's about structuring the corporate entities so that an operational recovery is magnified into sustained, robust profit. Their footprint in Jordan is literally the underlying secret weapon behind this remarkable turnaround. Which leaves us with this final, somewhat provocative thought. We've seen exactly how Jerash reversed a massive loss into a nearly $2 million profit through scale, cost control, and a really strategic tax advantage. But the global apparel market is famously volatile. It's constantly subject to changing consumer tastes and shifting shipping costs. So will Jerash's tax-advantaged global machinery sustain this profitable momentum into the next fiscal year? Well, I highly encourage you to keep an eye on their next quarterly filing to find out. Thanks so much for joining me to unpack this fascinating company today. And as always, stay curious and keep learning.